After a brief pause last week, Indian markets have resumed their downward trend with major indices Sensex and Nifty hitting a 4-month low. On Monday, the Sensex plummeted by over 900 points while the Nifty 50 closed below the 24,000 mark as uncertainty surrounding the highly contested US presidential elections weighed heavily on investor sentiment. Volatility also spiked, reaching a 3-month high. Now, in a single day, investors saw their wealth diminish by over 6 lakh crore rupees with widespread selling witnessed across all sectors. So what's next for our stock markets? Will this correction continue, and if so, for how long? To shed light on these pressing questions, we are joined by Amar Deo Singh, Senior Vice President of Research at Angel One. Amar, thank you for giving us time here on News 9. Now, last week, if you count the Mahura trading day, it was actually a positive one for our markets, which, led many of us to believe that the worst may be over. But today, once again, the headliners have made a new low and selling was witnessed across the board. I mean, what do you think led to this fresh bout of sell-off, and for how long can the markets correct from here on?
See, if you look at the markets, because if you look at I'll talk about both on the fundamental and the technical side. So what we are seeing here is that investors, definitely they seem to be slightly concerned with regard to the earnings going forward, based on the earnings that have come out and also based on the reports that are coming out in terms of the slowdown in demand. So that's one factor. Secondly, we've seen some significant record selling by the FIIs, close to almost 1 lakh crores worth of selling. So that clearly tells that there is something which they are understanding, which others might not be understanding. One. Secondly, that could also mean that they are finding some better opportunities elsewhere. These are the two reasons which could be there, because otherwise, because if you look at the US market still continues to remain buoyant. But we've seen some selling here, so that is a concern which is definitely prevalent. And also, what we're seeing is that across the board, some of the heavy caps, including the likes of Reliance, they've also corrected. But I would say we also have to understand that markets have rallied significantly, despite this correction at 24,000. If we remember, 4th of June, we were at 21,000. So still, we've traversed and traveled a long distance, and corrections are a healthy sign of any market. The key question is that how long and how deep is the correction? So if you look at the market structure from a technical perspective, earlier 24,000, 24,200 was acting as a very crucial support zone. That has been taken out. We've seen a close below 24,000 levels. And also we see that immediate support is today's low, that is 23,800. But the structure of the market basically tells that higher levels will be sold into, because what has happened is that the intermediate term trend that has become quite negative despite it moving into oversold territory. That's the reason we could expect some pullback, some short covering, all that would happen. But sustaining is the key question. For that, Nifty will need to sustain over the 24,300 to 400 zone consistently. Then we could say that there is a possibility of a trend change. Otherwise, we are saying that the short-term, intermediate-term trend continues to remain bearish. Long-term trend, however, uptrend is intact. So there could be further selling, and also there would be some, I would say now this week is going to be important in terms of the US presidential elections, also the geopolitical tensions, and the US dollar, which way the US dollar actually moves. Because the dollar index did depreciate and then again it appreciated. So these are basically three triggers which are going to be very important. And fourthly is how does the US, because US presidential elections wouldn't have that much of an direct impact on us, but how the US market really behaves and reacts is something which could have an impact globally. So these are 3-4 triggers which are important to keep a close watch on. But yes, any significant correction is a buying opportunity, no doubt about it.
All right, speaking of the US presidential elections, what do you think is worse for our markets, a Kamala Harris win or a Donald Trump win? I was reading some brokerage commentary which suggested that, if Harris wins, the US Federal Reserve may continue to remain accommodative and we may see another 25 basis point cut later this week, which, could prompt the RBI to also start its monetary easing. Now, this is a positive for us. However, if Trump wins, they may adopt a hawkish stance to keep the yields and the dollar high, which could, lead to more selling from foreign investors and hence a negative for us. Do you agree with this analysis?
So I would actually say that I don't see much of a impact either ways. There could be some knee-jerk reaction, but just like I would say the Indian elections wherein expectations are of 400 seats, but only 239, 240 came. But the market reacted and then it took off. So the market basically, we have to understand that any economy does not work just by one person. So it's a complete ecosystem in itself. So yes, that definitely has some knee-jerk reactions because those are important positions wherein you can, to a certain extent, influence the policy, but you really can't change the economic dynamics that quick and fast. So having said that, see, if Kamala Harris wins, and that's a sign of continued policies. But if Donald Trump comes, then yes, definitely there are signs that there would be some knee-jerk announcements, knee-jerk reactions, which markets might not be prepared for. So there could be some flip-flop in the markets, but overall markets will act the way they have to act, and that's primarily corporate earnings. So whichever way things move, it's the corporate earnings which effectively drive the markets. And yes, and they definitely, the corporate earnings definitely depends upon the ecosystem, the economy, the interest rate, and the rate cut, and the currency fluctuations. So I wouldn't right now read much into it.
All right. Speaking of the quarterly earnings, Amar, the September quarter earnings so far, at least, they have been quite disappointing. Do you think this weakness will persist for the remaining 2 quarters of financial year 2025?
So see, we have to understand that corporate earnings had really been quite strong and firm, but now we are seeing some sort of topping out pattern, some sort of declining trend, and a trend basically definitely once it starts, it continues for a couple of quarters before it bottoms out, and then you see a turn around, and that turnaround would be a factor of as to how the inflation plays out, what step does the RBI take in terms of rate cut, if any, we are planning out. And so these are a couple of things which the RBI and the currency move definitely. And fourth is a close watch on crude oil. These are 3, 4 factors which are very important and essential for actually directing the direction of the interest rate, which would again is be a factor of all these trigger points which I have mentioned. So corporate earnings, yes, they could be under pressure, and that's what some of the FMCG companies, as well as I would say some of the automobile companies have also spelled out that they could see some slowdown definitely, and that's a given fact. I would say that also gives an opportunity to get into stocks which have corrected by 20%, 30%, and we'll have to watch out for, I would say, major levels of the indices. They are very important, very crucial. Don't be in a hurry to enter the market, because some of the technical indicators I have been talking about for quite some time, they are quite negative in the sense that, so that tells that any pullback will be short-lived, and sustaining isn't going to be easy until unless we see some fresh positive triggers coming into the market.
All right, for the retail investors out there who have seen the markets correct by about 10% from the record highs, what would be your advice? Should they try to catch a falling knife, or would you advise them to stay away from the market for now?
See, for retail investors, advice is very clear that if you have the time, the patience, and the discipline to learn, then get into stock picking. Otherwise, mutual funds, ETFs are the best place. It could be Nifty 50, Nifty 50. It could be the NSE 500 stocks. And you continue on investing in a SIP mode. So you'll find that over a long period of time, you'll beat most of the performance of the mutual funds, no doubt about it. So that is something which, and also most important is the risk appetite, because when you are entering into stocks, so for example, you see a correction of 30%, 40%, but if you are entering into a mutual fund which is quite diversified, or an ETF, for example, Nifty 50 ETF, benchmark indices, so there the correction isn't as much. So it also is how much can you stomach the volatility, how much volatility can you really take in. So these are some questions which I think every serious retail investor need to think about it. And otherwise, if you are into stock picking, definitely, but you should have one portfolio, or maybe a core portfolio ETFs and mutual funds, and a small satellite portfolio, which could be of your stock picking, wherein you are trying to pick some stocks, and then you can see how good you are in terms of the portfolio which you have in mutual fund or ETF, whether you are beating or not. So if for the next 3 to 5 years you see that you're not beating, then rather spend your time. You can invest in these cases, which are far better off as compared to your FDs. So the most important thing is you have to stay invested and continue investing even despite the downtrend, but you'll have to have that patience, which unfortunately most of the people they lack there. That means when they need to invest, they don't invest, and when they should be careful, there they are going all out. So these are, I would say, certain advice which I would definitely like to share.
To follow up on this, would you say that this era of momentum in the markets is over? Because, since COVID, given the excess liquidity in the system, the only way the market was going was up, up and up.
I would say era is a very broader sense, very long term. So I wouldn't say era because we still have a long way to go, because if we are at 24,000 in Nifty, someday we'll touch 50,000 also. So that trajectory is definitely on the upside. But yes, you are right that the momentum play, which was earlier there in terms of many of the funds that also come out with their funds and PMS with their momentum play, that is definitely now a challenge for most of them, because ultimately you are right that if you look at real estate, if you look at gold, if you look at stocks, ultimately it is liquidity which drives the prices. So it's like the tap. So you close the tap, so water doesn't come. You open it, the water keeps flowing. So now the tap is to a certain extent being closed. So that now we'll have to watch out as to how the domestic flows in terms of mutual funds. What is the flow, because they generally tend to have a lagging effect. So we'll have to watch out as to how November really plays out. November, December, these are going to be important months to watch out for. That could give us some idea as to what's going to happen in the future in terms of the flows, because ultimately it's the flows which actually define and determine the stock prices. And if the flow is weakened, where we are seeing in terms of the FII flows, so that will create or give us a better picture in terms of domestic flows.
All right, I want to focus on the domestic institutional buying over here, because so far the FII sell-off has been more or less absorbed by the DIIs. But for how long can they continue to support the market? I mean, at some point, the foreign investors would have to return to the table, isn't it?
Yes, see, definitely. Foreign investors, as I said, they are definitely, they see, you have to understand that those who are professional fund managers, they don't have any I would say, affinity or particular commitment to any asset class or any country. Like, for example, domestic financial institutions, they have nowhere else to go. They have to invest in India. But the FIIs, they've got multiple opportunities. They can invest in any country, in any asset class, and they've got a plethora of opportunities. So for them to go and then come back is something we'll have to really watch out for as to when they come back. But the good part is that our domestic, I would say, institutions in terms of both on the retail side and the institution side, they have matured a lot over the last decade or so. So despite the record outflow by the FIIs, the markets haven't really corrected. I would say the benchmark indices haven't really corrected much. So that definitely speaks volumes. And we should definitely give a credit to the retail investor also to a certain extent. But yes, till the time we don't see because the more the merrier sort of thing. So once you have these FIIs back in full swing, that definitely adds more to the momentum, because ultimately, as I said, it's the liquidity flows which really matter. So that coupled with the domestic flows would be a better bet, I would say.